to use an example to check if you understand all these cases. So let's say X Limited has a year-end date on 30th of June, and Mr. A, as a director who has an outstanding loan of 50,000 at June 30th of June 2019. If he did not repay this loan before the 31st of March 2020, there will be tax charge of 4,875 for the company in respect of the advance. So how this could be calculated, as I said, the Section 455 tax charge rate is 32.5%. If it is not being paid, if the loan has not been paid before the 31st of March, this tax charge rate will multiply by 15,000, which is the outstanding loan amount. So that the result will be 4,875 for the company to be paid as tax charge liability. However, if Mr. A decided to pay the loan on 1st of August 2020, and this is account period ending with 30th of June 2021, so the company will be able to claim the repayment of the amount 4,875 on 1st of April 2022, which is since the year-end date 30th of July 2021, after 9 months plus 1 day, the repayment can be able to be claimed. So this is a very simple case. Hope it can help you to have a further understanding about how to calculate it about the liability and in which date the repayment can be claimed. So is there any exemptions for this tax charge? The answer is yes. So a closed company loan will be subjected to will not be subjected to a Section 455 charge, where the borrower total loan do not exist 50,000. So if you really want to withdraw the amount of money from the company as a loan, so I think just to make sure that the amount is not exist 50,000. Otherwise, the Section 455 will be triggered. The next scenario will be the borrower works full times for the company or any group associate of the companies. So the Section 455 won't be triggered. And another scenario is the borrower does not own more than 5% of the company or its association. The Section 455 won't be applying here. Or for the family business, a loan made to a spouse or civil partner is not counted. Or where both husband and wife are directors or employees, they will each be entitled to a separate limited of £50,000. This is not a merge or joint account. So some of you might thinking that what if I repay the loan and then withdraw the same amount in the subsequent period? So you might think that this can be the way to avoid the Section 455 charge, because this is a question being asked by our team. So I would like to say we need to be very, very careful with this. So let's see an example. Let's see another example to describe this scenario. So there's a Dr. A is a full-time working doctor, and he is also a participator of a closed company. So the first condition, check. And the second one is, and he also has a loan account is overdrawn by 20K. So the 20K exists 50K. So the second condition, check. And 2 days before the end of the accounting period, the doctor repaid the 20K to the company. And on the 3rd day, he takes the new loan of the 20K. So this is exactly what the scenario we described before. So in this case, it will be treated as temporary repayment. and the repayment will be matched with the new loan rather than the original loan, and the company will still be liable for Section 455 tax charge on the original loan because it is not being treated as being repaid. So it means that the company still be liable for this Section 455 charge. So, as I would like to, as I was saying, you need to be very careful with this case with this scenario, and you make sure that the actual loan accounts being debited correctly, and do not trigger any further liability from the penalty and the interest because of the underpayment tax. So normally each individual directors has a separate loan account. So each director loans should be considered separately from a full Section 455. Or some of the spouse directors might join their account together, but it's very rare happened. Even for the same person, it might have separate account for different kind of loans. Or if they think that the loan is supposed to be paid by different resources, they can consider to separate the loan accounts in with different payment ways. So the reason why we need to do this is we need to check if the director loan account have been credited correctly. This is very, very important. So let's see and another examples to help us understand why you need the separate account is a priority option because it can help you to understand the credit and account it correctly. So Director B is a full-time working directors and a participators of a closed company. So the first condition check. And he has an overdrawn account of 20K. So the second is a condition check. Accounting period is 31st of December 2020, and at the annual general meetings on 31st of October 2021, a director bonus is voted, and the net bonus is credited in his loan account on the same day. So it means that the bonus is therefore paid on 31st of October 2021, and the PAYE and NIC is due on the same day. So with this scenario and with this example, so we can say the Section 455 tax of 20K, overdrawn balance of 20K at 31st of December 2020 is being paid on the 1st of 10th 2021. So the tax charge repayment is due on 1st of October 2022 because at the year since the year end accounts year end date 31st of December 2020. After 9 months plus 1 day means the 1st of October 2022. The director bonus was paid during this period, and the relief is due after 9 months plus 1 day, means the 1st of October 2022. So with this scenario, you can see with this simple case how complicated the date can be calculated. So if you repayment method or sources with bonus and dividend and etc., you really want to separate this account to make sure that you accurate the payment date and you can get the repayment with the correct date as well. So it really helps if you can separate your direct loan account.